It was a week with a little bit of everything. A summit, an infrastructure bill, a COVID pill, and a whole lot of worry about inflation. This is Bloomberg Wall Street Week. I'm David Westin. This week, special contributor Larry Summers on that question of inflation and what we might not be thinking about.
I think that the desire to maintain credibility when you've made a big mistake is the source of some of the biggest disasters we've had in the United States.
And former IBM CEO Sam Palmisano on the continuing crisis over supply chains and what we could do about it at this point.
It's very, very important that the United States of America has a policy of investment into those spaces to make us self-sufficient.
As government and business leaders gathered for the Bloomberg New Economy Forum in Singapore, they had no shortage of things to talk about, from concerns over China.
We should be concerned. I don't think it's going to war overnight, but this is a situation where you can have a mishap or a miscalculation and be in a very delicate situation.
To concerns that the party may end even if they haven't taken that punch bowl away.
When I step back and I think about my 40-year career, there have been periods of time when greed has far outpaced fear. We were in one of those periods of time. And generally speaking, my experience says that, those periods are not long-lived. Something will rebalance it and bring a little bit more perspective.
And whatever the topic, the specter of COVID was never far away. It wasn't just talking that got done this week. There was also some doing, as President Biden finally got to sign that infrastructure bill into law, saying it was really a game changer.
We're at an inflection point in American history. This law meets that point. For most of the 20th century, we led the world by a significant margin because we invested in ourselves.
But with all the doing and all the talking, the biggest topic of the week by far was simply inflation, with some members of the board now saying it may be time to get a bit more hawkish, like James Bullard from St. Louis.
It behooves the committee to tack in a more hawkish direction. We could move faster. We kept optionality on this, that we could speed up the taper if it's appropriate.
And when the week ended, it was that inflation story that drove the markets, with a dollop of COVID concern. As the yield curve flattened and the 10-year yield fell down towards 1.5% again, helping out tech stocks and taking the NASDAQ up by 1.24%, while the S&P 500 held its own, up just 0.3%. But it was the Dow that took the hit, down over 1%. Here to put it all in the investor's perspective are John Graham, CEO of CPP Investments, managing over $500 billion for assets for Canada's largest pension fund, and Catherine Keating. She's CEO of BNY Mellon Wealth Management. Welcome to both of you. So, Catherine, let's start with you. Inflation, I think, was the big story of this week. How did it affect investors' views of the marketplace?
So I think the new inflation news this week and in recent days has been that we see some signs that we may be seeing some peaking. We see it in inventories starting to build in certain sectors of the economy. We see it in some of the port log jams starting to ease a little bit. And we see it in emerging markets starting to tighten, which is a deflationary force that will affect the global economy. But I think for markets and for investors, the question really is, where do we see inflation a year from now? Markets always look ahead, and a lot can happen in a year. Think about last November. Think about last Thanksgiving, how different it was than what we're expecting this year with vaccinations and travel. And so a year from now, what do we think? We would use the word not transitory, but transitioning. Transitioning from the higher inflation that we have right now, 5 and 6%, but also transitioning from the very low inflation we had in the decade after the global financial crisis, which was less than 2%, to something more in between, 3 or 4. And what we need to remember, to your question about markets, is that markets have behaved very well with inflation in that range for most of our careers as investors.
Yeah, no question, they have performed well. So, John, do you agree with that analysis? Maybe we're transitioning not to 6%, but to 3 or 4%. And if so, what does it mean for your investors? And particularly, you need to worry about all those pensioners out there waiting to have their checks when they need them.
Yeah, I think we would have actually a very similar view. And I think probably every day this week we talked about inflation, and the word that kept coming up was transitory. And my question is always, what does transitory mean? It's not that helpful a word without a time horizon put on it. And I like the word transition. 6 months ago, we probably thought it was shorter. It would be a shorter horizon than it's turned out to be. We didn't anticipate all these COVID-related shocks to the supply chain, but we still do believe longer term that, and when I say longer term, I mean 12 to 18 months, we're going to get back to an inflation that is more similar to where we've been in the past. Really a belief that the supply chains will work through the issues and capitalism will find a way. And for our beneficiaries, we are really thinking about that from a 5, 10, 15-year time horizon.
So, Catherine, when it comes to the question of inflation, it's not just goods and dollars, it's also the Federal Reserve and how long they think they can put up with it. We had, as I say, toward the end of the week, 2 members of the Fed come out and say, you know what, we think we need to speed it up a bit. If, in fact, they do need to speed up the tapering and maybe the increase in interest rates, what does that do to investments?
So it really depends, right? Inflation can end a cycle if if the bond market responds. Inflation becomes a problem when the bond market responds, and we don't see that right now. We see a very gently upward sloping yield curve, which is what you want to see. It says that we expect growth, but we don't expect too much inflation, which would be a steeper curve. And so we don't see that right now. And I think an interesting question, in addition to the Fed, is how are people responding? Because consumers are 2/3 of the economy. And how are people responding? Consumers know they feel inflation every single day at the grocery store and at the gas station, and if they want to travel or go to a restaurant, we're all feeling it. But what are we doing? We're buying anyway. It's not stopping the consumer. And I think we have cranky consumers, right? We're all cranky about it, and that's probably a political issue, but it hasn't really become an economic issue. And consumers still have $2 trillion in bank savings from the stimulus. So it's not really changing consumer behavior, it's changing the consumer's mood.
So, John, this is a really important point, I think. It's not just a question of how much things cost, but are we growing overall? And as Catherine points out, we also had retail sales numbers this week, which were pretty darn encouraging, I must say. Is that an important indicator for you of the growth pattern for the economy and therefore potentially the growth of investment?
I would say we're still reasonably constructive on the economy. And maybe building on the point, longer term, we continue to see probably some headwinds to inflation, with demographics, with globalization being forces that will actually keep inflation in check over the longer term. We continue to see, continue to be constructive on the economy, but we're also a global investor. And I think one of the things that's interesting is to see the divergence in the global economy and the divergence in the global economy based on how different economies have approached COVID. And we're seeing it right now in Asia and Europe and in North America.
So, John, just to follow up on that, if I may, is there a better opportunity right now, particularly when you talk about valuations, overseas than there is in the United States? And I don't necessarily mean Europe. I may well mean Asia, maybe China, but Asia in general. Is the valuation more attractive there? Because let's be honest, the equity markets in the United States are pretty fully valued, are they not?
Probably some segments of the equity markets are pretty fully valued. The way we would think about it is we're a global investor. We've built out the capabilities to do lots of different asset classes around the globe, and capital should flow to the best opportunities around the globe. We're seeing a divergence, how countries went into COVID, how they're coming out of COVID, and certain asset classes are certainly presenting opportunities around the globe. We see opportunities in Latin America, we see opportunities in Asia, in India, but also see lots of opportunities in the US.
So, Catherine, back to you, the same question, sort of, where do you see full valuations and where do you see opportunities?
Yeah, so I'll go back to people, right? And how are people responding to what they're seeing in inflation in the markets? And, what you see people doing, they might be cranky consumers, but they're actually very contented investors, right? Because we've seen, the S&P 500, the NASDAQ, the Russell 2000, the small cap index all hit highs during the month of November. The NASDAQ hit another one today. And so we might be cranky about what we're finding in the grocery store and with our grocery receipts, but we're very happy when we open our 401k statements and our statements from our financial advisors. And in fact, what you see is that the individual investor is really all in this equity rally. We have seen what looks to be probably a record year in equity fund flows, a lot of which is driven by the retail investor.
John, I want to talk about one thing that happened this week, as I mentioned, which is the signing of that infrastructure bill, I mean, you have the advantage, I think, of being a patient investor as a practical matter. Does infrastructure offer an opportunity today that it didn't a year or two ago?
I would agree that signing of the infrastructure bill could be a game changer. Infrastructure for institutional investors around the globe it's a great asset class. It's a great asset class that it offers stable returns. And what infrastructure investors want to see is a pipeline of high quality assets. They want to see a pipeline of high quality assets where there's a stable regulatory regime. And with this infrastructure bill, we could see a lot of capital moving in and looking to participate in some of these projects. And I think a real opportunity to have public-private partnerships. We've been invested in the Transurban Chesapeake, Chicago Skyway, Puget Energy, and we see this infrastructure bill as something that could be a game changer.
Fascinating. And what about real estate, commercial real estate, back to the office? Are you invested in that as well?
Yeah, real estate's an interesting asset class. And in our portfolio, and thankfully a few years ago, we started to transition our portfolio into logistics, looking at the potential for e-commerce. We obviously never anticipated the pandemic and benefited tremendously from the kind of rise in e-commerce during the pandemic. We've been investing in logistics across the globe, Japan, Korea, United States. On the office side, I think probably still trying to figure it out, trying to figure out what the winners and losers are. And office is something that there is dispersion, but I'd say we're probably, for high quality assets, we're still investing.
So, Catherine, one more asset class, if it were, as it were, energy. There's been an awful lot of talk about energy, both because of COP26 and the climate issue, but also maybe some opportunities in energy, as we see, for example, almost a crisis in natural gas prices in Europe. What do you advise investors who are interested in energy? Is that a segment to get invested in?
So energy has become an increasingly small segment of the indexes, right? It's a smaller segment than it was in the past. And what we would say to our clients is, again, we have to look at what's driving the economy, right? And what is driving the economy is consumer spending, it's business investment, and you want to be invested in really a broad section of the economy right now, because we're seeing it across, small companies, big companies, tech companies. So you really want to have a diversified portfolio, and it will include some energy, for sure.
You have the advantage of dealing with clients day in and day out. What's the number one question they're asking you right now?
Inflation. The number one question they ask us is inflation. Well, they feel it, right? We feel it when we shop. And what we say to them, I'll echo what John said, the deflationary factors that were in place before the pandemic are still here, right? Demographics. All of the major economies in the world are aging. The US, Europe, China, Japan. We're the young one on the block, but we're aging too. The average age in this country is almost 40 now. So that's still in place. Technological disruption is still in place. But the new thing that we've picked up during COVID is productivity. Productivity is a huge antidote to inflation. And we've recovered all of corporate America's earnings and then some, all of the US economy and then some, with 5 million fewer workers. Wow. That's productivity. And we see it across sectors. We see it in healthcare, we see it in retail, we see it in financial services, my sector. And we think that's going to continue, and we think that's going to help to contain inflation to that 2 to 4% range over time.
John, Catherine mentioned technological innovation, and perhaps a lot of that productivity in some sectors is driven by technological innovation. How about tech as an investment? Has it run its course? It's been driving the market for so long now. Do you see more opportunities in tech?
Yeah, we still do. We still see more opportunities in tech. We just participated in the McAfee take private. We're looking forward to kind of the growth of cybersecurity in the consumer side. One area of tech we're actually really interested in is technology to help transition the economy to net zero. Technology that's really focused on decarbonizing the economy. There's a real opportunity there.
So, Catherine, what about this ESG issue? Is there an opportunity there? I mean, because we hear about green mail, things like that. You can make mistakes there.
You can, but we know a lot more about ESG today than we did 20 years ago. It's not a brand new investing strategy, not a brand new investment strategy. And what do we know? We know that it doesn't necessarily mean you will get lower returns. We know that we're coming out of a global pandemic where everybody is focused on values and what's important to them and legacy. And so we see that there's a lot more interest in ESG. And we also know, again, the individual is 70% of the economy, the individual is also 70% of financial markets today. If you include 401ks that we control, plus our personal savings, and individuals are increasingly interested in this as they learn more about it.
Yeah, it's fascinating. Also adds, as you and I talked about in the past, some volatility in the marketplace with all those individual investors.
Yes,
those
they tend to
investors.
be a little pro-cyclical as opposed to John, who's definitely counter-cyclical.
Exactly.
We want our investors to behave just like you, John.
Thanks so much to our panel, Catherine Keating of BNY Mellon Wealth Management and John Graham of CPP Investments. Coming up, some highlights from the Bloomberg New Economy Forum over in Singapore. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. This week, Bloomberg sponsored its 4th annual New Economy Forum in Singapore. And here are just some of the many high-profile guests we heard from.
China cannot develop in isolation of the world, and nor can the world develop without China.
China needs to play by the rules. They need to respect our IP. They need to live up to their commitments. You know, right now, for example, in the so-called Phase 1 deal, where the Chinese committed to purchase a certain amount of, aircraft and agricultural products, they're not doing that. They're not living up to their commitments.
We should be concerned. I don't think it's going to war overnight, but this is a situation where you can have a mishap or a miscalculation and be in a very delicate situation.
I assume that Chinese leaders will work towards the maximum capability of their country. Our task as Americans and non-Chinese is to understand what we need to do to make sure that there is at least equivalence and in no case subordination.
I think the Americans are actually coming to the right type of policy posture towards China. None of that means that there's not going to still be some pretty fierce action on both sides, and there are all sorts of risks and dangers with this relationship, but it remains the key to 21st century stability.
Everyone says, well, what should President Biden do more of to improve the U.S.-China relationship? That question should also be posed to President Xi Jinping. What should China do more of to improve that U.S.-China relationship?
The real risk is either an accident or a miscalculation. And the more there's engagement, there's talk, there's discussion, and there's hopefully a meeting of minds, I think that lowers the risk considerably.
I think they need to both take a little more time to better understand each other. There's some disconnects right now. I think Biden is trying to engage more, but there's still some disconnects.
Wholesale financial decoupling is impossible, and partial decoupling is likely to make the United States, China, and the world more susceptible to financial crises. It is crucial that we have mechanisms for the world's first and second largest economies to coordinate, because the only way to put out the next big fire will be with global coordination.
The Chinese economy has been big as a manufacturer of the world for many decades. It's also huge as a consumption market for the future. And I don't think the world can decouple from one of the biggest manufacturing nations of the world and what will be one of the biggest consumption markets in the world. So I really hope it doesn't decouple. Will there be differences? Differences in views on technology, differences in views on politics, yes. But I think it's important that there is a level of connectivity between the world and Asia and between the U.S. and China.
What's important is the U.S. re-engages with the region, shows leadership, we are a Pacific power, and finds ways that work politically at home, but also from an economic perspective to integrate with the region and to help build on, for example, the digital economy dynamics that are so critical.
Today we don't provide most of our signed-in services in China, and I don't see that changing. But there are ways, as I said, in areas like AI or sustainability, I think there'll be opportunities for us to work together. through cloud, we will support multinational companies which have presence everywhere. And so maybe there are opportunities to work that way as well.
One of the issues that is really underpinning some of the dynamics between legislation preventing Chinese companies from remaining listed in the U.S. is about the PCAOB oversight. And so making sure that they're subject to the same investor protections that all other companies in the U.S. are. And that's the dynamic that we're working through and that our regulators and governments are looking at.
I think most of the regulation that we see around our space is well telegraphed. So the government wants insurers out of the bank space, out of the shadow banking. They want them investing in long term, right? And they want them well run, well capitalized. That aligns with our view of risk.
I wouldn't say there's direct pressure on us to change our long-term plans to grow our business in China. Is it possible at some point in time something goes on geopolitically between the U.S. and China, and because we're a U.S. company, there's either pressure or directive for us to do certain things differently? Sure, that's a possibility. But we think about this with a 10, 20, 30-year perspective, not with a next couple of year perspective. And so we're long-term committed to continuing to serve our clients by having the resources and the capabilities in China that allow our clients globally to participate in markets.
Coming up, we take a look at the week ahead on Global Wall Street. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. Let's take a look at what's coming up next week on Global Wall Street, starting with Annabelle Drulers in Hong Kong.
Thanks, David. Well, this week in Asia, we'll focus on the central bank hawks. Korea may lead the region and kick off a tightening cycle. Meanwhile, New Zealand could bump rates 0.5 percentage point higher, though that's seen as more of an outside chance by Bloomberg Economics. Over in China, there are some key earnings due, including from EV maker Xpeng. Xiaomi, now this is the world's second biggest smartphone maker, they'll report as well. And finally, we'll track efforts from the US to bolster key alliances in Asia. Trade Rep Catherine Tai meets her counterparts in India on Monday and Tuesday. To Laura Wright in London now.
Thanks, Annabelle. Well, here in Europe, we're on standby for news of Germany's new coalition and also who the incoming Bundesbank president will be. On Tuesday, PMI data will be released for the UK, Germany, France and the wider Eurozone. On Wednesday, the IFO index serves as a barometer for economic expectations. Thursday, it's the turn of Sweden's Riksbank for a rate decision, and the end of the week, Friday. Yes, it's Black Friday, but the focus this year is on supply chain disruptions and whether retailers will pass on the higher cost of raw materials to consumers. Romain.
Thanks, Laura. Financial markets in the U.S. face a shortened week because of the Thanksgiving Day holiday on Thursday and a truncated trading session the day after, which is typically the second lowest volume session of the year, second only to Christmas Eve. However, the inflow of news does continue. Look for economic data out on consumer incomes, wholesale inventories, new home sales, and durable goods, as well as the latest revisions on the third quarter GDP numbers and the release of minutes from the FOMC's November 3rd meeting. Earnings season also continues with reports scheduled from chipmaker Analog Devices, software company Autodesk, tractor maker Deere, and retailers Best Buy, Gap, and Dollar Tree. In fact, retail spending overall will be in focus, as is traditional during Thanksgiving week, with Black Friday marking the official start of the holiday shopping season. This year's Black Friday, though, arrives with supply chains still choked, promotional discounts scarce, and inflation eating away at the disposable incomes of many families. David?
Thanks to Annabelle, Laura, and Romain. Coming up, the chip shortage continues. And the question is what to do about it and how to make sure it doesn't happen again. We asked the former CEO of IBM, Sam Palmisano. This is Wall Street Week on Bloomberg.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. The supply chain. One of those things we took for granted before the pandemic, but that now affects almost every corner of the economy and has hit the auto industry particularly hard, as President Biden explains.
So if a factory in Malaysia shuts down due to a COVID outbreak, which they have, it causes a ripple effect that can slow down auto manufacturing in Detroit.
Minneapolis Fed President Neil Kashkari says things are getting better.
Malaysian chip factories are now coming back online to try to supply auto companies. I also recently learned that all the major auto plants in America have restarted. I'm not suggesting that we're out of the woods yet, at all, but many of these sectors are working themselves out.
But despite the improvements, GM's Mary Barra says she's looking for a more permanent fix.
We'll be in a much better shape in the second half of 2022. And we're also taking steps over the medium term to make sure we're never seeing this kind of constraint.
An important part of that longer-term solution, according to Michigan Congresswoman Haley Stevens, will be legislation pending in Congress to support more chip manufacturing in the United States.
We have got to pass the CHIPS Act. This is what I am working on every single day as a member of Congress, and certainly as a member of Congress coming from Michigan. Our automotive companies need that certainty. And yes, our American people need relief from the everyday costs that are impacting them.
And when it comes to supply chains, particularly tech and especially chips, no one knows it better than Sam Palmisano. He's the former CEO of IBM, and he's now the chairman and CEO of Global Enterprise, which deals with cybersecurity issues right across the country. Sam, thank you so much for being back with us on Wall Street Week. Let's break this down, as you suggest we break it down, into right now the problem with supply chains, specifically with chips, and then what happens over the next 6 months or so, and then strategic. What about right now? How bad is the situation? Is it getting better? Where are we?
Yeah, David, thank you. Again, thank you for having me as always. As far as right now, I think you had a great quote in our lead-in, which was from the Fed President, Neil Kashkari, which is about Malaysia and how things are improving, at least in automotive chips. And things are improving, but it takes time to work through the supply and demand balance that'll occur. But things are getting better. They're loosening up. Once we solve the chip problem, there'll be other problems called packaging, but that's more of in the IT segment versus the consumer segment, like automotive or appliances. But things are improving. But we have a ways to go, and companies need to do things differently as we go to the future.
What can companies do to try to ameliorate the problem, if not fix it entirely, over, say, the next 6 months?
I think the thing that they are doing, quite honestly, and they've started to do, and I think you've seen this in some of their products, they're working on design and supply. You have to do both. By that I mean you have to reduce the demand to get in balance with the supply that is available. On the design side, you'll see them using fewer chips or maybe consolidating functions within a chip or a board, as it's called, so that you can use fewer chips to get the same functionality in the product. At the same time, companies will make long-term commitments to their suppliers, form partnerships. I believe Ford announced one this morning with Global Foundries is a good example of that, where they're going to make long-term supply commitments. And on both parties, I mean, clearly, perhaps to cost them a little more, having been in this business on both sides, both a buyer and a supplier. Like, yes, costs could go up, but you're much better off having quality products that you can ship to your customers, even if it has a small cost impact.
So, Sam, on the redesign point, I think I mentioned to you, actually, I went and looked at a Ford Maverick, this new small pickup, and they went out of their way to say, you know what, we made the screen smaller. It's now a key ignition. Remember, we used to have those instead of push button?
Yes.
Specifically to reduce the semiconductor needs for the vehicle. How fast can a manufacturer really retool?
Well, it depends. If it's a software change, they can do it, I mean, pretty quickly, immediately, like next year's models, for example, right? If it's a hardware change where it requires bending metal, for example, then it's a little more complicated because now you're dealing with your manufacturing line. But quite honestly, the changes that they've made, like you buy a smaller screen size and you use a key versus a push button, that's mostly software.
So, Sam, you also mentioned strategic relationships such as Ford and Global Foundries that's been announced now. Give us a sense of the spectrum from let's do it in-house, because there's some talk we'll design the chips inside our own company, even if you're an automotive company, to have a strategic relationship to actually just be a customer. How do you decide among those alternatives if you need the chips?
I tell you, the way I always think about it, I'd start with your product differentiation. How do you make yourself competitive versus your competitors, their offerings, and then therefore capital allocation, i.e. in a fab itself. So I'll start with the fab itself. Even a small fab today is $3 to $4 billion. One that Intel will build is probably $8 to $9 billion. IBM were $5 to $6 billion. So it's a huge capital allocation, and therefore it requires a lot of volume for that fab to make sense. So therefore, if you're not in that industry, you're probably not going to build your own fab. You can reserve capacity with a partner. You can pay for that amount allocation of their manufacturing capacity is the term. But I would not recommend they go out and build their own fabs. It's really, really technical. They're talking about 5 nanometer. It's like 3 atoms on a circuit and things like that. It's extremely hard to do. Now, on the other side, where you can get great differentiations around design, and a lot can be done on design, and you have to work with your partner because that becomes part of the data that they load into the chip. The algorithms for how the chip works. But nonetheless, as you partner with your whomever your foundry is, whether it's Global Foundries or Intel or Samsung, there's multiple, TSMC, et cetera. My point being is you can get terrific differentiation through design. If you look at AMD and their stock, they've moved more to a design shop than a fab, and you can see their stock is up tremendously because of their success there.
Sam, we've been talking about the now, here and now, and then the near future. What about the longer future? What are the strategic solution here? And if I can, you'll tell me if this makes sense. Can we divide it into what's good for business and the economy and then turn to national security? Because I think they may be somewhat different considerations.
Yes, they are, but they do converge. But that's an excellent observation on your part, Dave, because they eventually do converge. I mean, if you think about it today, which we're seeing for the first time, that data and semiconductors are the lifeblood of the economy and also important to national security, but they are the lifeblood of the economy. It's like the oil of the 21st century, of the past, but now applied to the 21st century. So having said all that, we need to have strategic relationships to, I would say, secure that capacity that protects the U.S. economy. That means we have to relocate, which gets us back to the national security issue, but we need to bring more of the capacity back into the Northern Hemisphere, or maybe our allies around the world. We can just discuss whether they have capability or not. That's a long conversation I wouldn't bore your audience with. But having said that, over 75% of the worldwide capacity today is in Asia. Taiwan, Singapore, Korea, that needs to be coming back to the United States, at least to solve the needs of the companies and in that country, quite honestly, our society in the United States. The reason why I say it converges is because that movement back to the United States, that's why you hear about in the bill that was the Schumer bill that's now being worked through the House and the Senate, the $52 billion, requires government involvement because it's a significant investment to bring those fabs back into the United States. It's both the fab itself and the future R&D. So that's where it all connects, because it's those facilities that are going to be both doing commercial work as well as work for, I'll call it, the protection of our national security.
Sam, I believe that bill is called the U.S. Innovation and Competition Act. Originally, a version it was called the CHIPS Act. It's a little bit mired right now. Passed through the Senate, the House is having troubles with it. But the $52 billion you referred to, is that enough to make a material difference? I've heard some of the chip producers say we can't do it without it. Is it enough to get us to where we need to go?
I think it's enough to do production. Now, there's a whole other element of this thing called research and design, or research and development, right? That's in the Build Back Better bill, which they're talking about $190 billion, if I'm not mistaken. I'm not sure if that's a good number or a bad number, but they need to do probably twice as much of production in research and design, because the point is that the way these chips are used in the future, it's very, very advanced research. You have to have the money to fund it. You need the academic relationships with the appropriate universities to help you work on these kinds of solutions. It's really a three-way partnership between government, academia, and business. But that research bill is every bit as important as the production bill. Now, it's clear that the focus today is on production because we don't have the supply to meet the demand. But that will be solved. And then in the $50 billion, I think will make us more secure and resilient. But we need to address the long-term requirements to be competitive as a country. That's both commercially and national security of the government, because the Chinese are outspending us dramatically.
Okay, Sam, it's always such a treat to have you contribute to Wall Street Week. That's Sam Palmisano. He is the former CEO of IBM. Coming up, we wrap up the week as we do every week with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. We end our week every week with our very special contributor for Wall Street Week. He is Larry Summers of Harvard. Welcome back, Larry. You've been talking about inflation since really early last February on this program and elsewhere. And early on in that process, you said as you looked forward to the Biden economic agenda as they were putting it forward, you saw three possibilities. Roughly 1/3 possibility of runaway inflation, 1/3 of a recession because the Fed had to react to that inflation, overreact to it, and 1/3 things would be fine. We actually went to Twitter and asked this week what they thought at this point, and basically what we had is 50% of the people saying they think runaway inflation, 50%, and then the rest were divided roughly evenly between a recession and not much at all. I want to know from you, given we have a lot more data now, where are you on the probabilities?
Unfortunately, I think the probability it's all going to work out well has come way down to perhaps 10 or 15%. I think the probability that, I don't know about runaway inflation, but the probability that we're going to have inflation for a while that's well above the 2% target, I think is about 50 or 55%. And I think the probability that we're going to try to control inflation and it's not going to work out and the economy is going to turn down more than we want, 30 or 35%. So I think the odds have gotten a bit more tilted to the bad outcomes and a bit more tilted to inflation than I thought. I say that because the inflation rates are up. I say that because markets have become more vulnerable. And I say that because the Fed's further behind the curve than I thought it was 10 months ago.
So let's talk about the Fed being behind the curve, because there was a piece on the Bloomberg this week that said, wait a second, we should track Volcker, but not so much in raising rates to really get inflation under control as reestablishing what was called credibility. That one of the things that Paul Volcker did was really reestablish the ability of the Fed to withstand political pressure, and therefore maybe it should stay the course, particularly with the new framework that Chair Powell put forward. What do you say to that if the Fed really did pivot significantly right now, it would lose credibility?
I think that the desire to maintain credibility when you've made a big mistake is the source of some of the biggest disasters we've had in the United States. That's what caused 55,000 soldiers to die in Vietnam. That's what kept us in a 20-year war in Afghanistan. What's most important is that policy have credibility as competent and able to respond to changing events. And that's what we need now. When the Fed put forward that framework, it had no contemplation that there would be COVID. It had no contemplation that we'd have record labor shortages. It had no contemplation that we'd have annual inflation rates on the CPI running above 6%. And so it has to adjust in the face of that. There's another lesson to learn, which is none of us know the future. And so confident statements about what's going to happen by public officials and confident statements about intention to act and what they're going to do rather than about objectives often turn out to be embarrassing.
So picking up on that uncertainty, as you say very wisely, we can't really tell the future. Part of what got us here was COVID and the pandemic and the uncertainty of that. That seems perhaps to be coming back in. We certainly see it in Europe right now with a lockdown being announced by Austria and certainly cases flattening out or even rising in parts of the United States. The Fed was concerned originally about deflation, in part because of the pandemic. What about the argument that we hear from the Fed, frankly, that we cannot tighten up too quickly because we may go back into deflation?
So I think, first of all, monetary policy is about balancing risks. The risk that we will go into some kind of chronic deflation in the next year or two, coming off 6% inflation with housing prices and the labor market on fire, is much smaller than the risk that we will need to crack down hard and the economy will skid into recession. Second, if we were to go back into deflation, we sure want the Fed to have some room to cut rates. And as long as they stay at zero, they're not going to have room to cut rates. And as long as they're still buying bonds, they're not going to have much room to step up QE. And so if we want to reload the cannon it's time for monetary policy to be acting more firmly. If we want to be guiding against the greater risk, it's time for monetary policy to be acting more strongly.
Larry, let's move to Capitol Hill and the so-called Build Back Better package, which did move through the House this week, in part because they got that Congressional Budget Office scoring, which everybody said was so important. You've said in the past that part of the reason it's unlikely to increase inflation, Build Back Better, is because it will pay for itself. It didn't end up paying for itself according to the CBO scoring. At the same time, you take some issue, as I understand it, with one part of that scoring.
David, if you look carefully, the only real gap between the CBO and the administration's estimate that it does pay for itself that's quantitatively important is in the tax compliance area, where the administration's proposing overdue initiatives to raise the investment in the IRS. The CBO discounts those initiatives almost completely. They say it's only going to raise $120 billion over a decade. And here's what I'd say. A nation that can do everything the United States has done can surely close 6% of the tax gap, 6% of the taxes that are owed but not paid. That's all the administration is assuming. And it surely can do that at a time when we have so decimated the IRS that it has fewer auditors than any time since the Second World War, and the audit rate has been allowed to come down by almost half since 2011. Look, there's a competition between those who use information technology to hide money and those who use information technology to find money. And unfortunately, those who've been hiding it have been winning. It doesn't have to be that way, and that's what investing in the IRS is all about. This isn't just my view. This is the view of Charles Rosati, the highly respected former Republican commissioner of the IRS, and Fred Goldberg estimate that the right IRS program could raise $1.5 trillion, more than 3 times what the administration is claiming. There is a list of academic studies that show that, contrary to what CBO is saying, common sense prevails. And if you audit more people, not only do you get money from the audits, but other people are more careful in filling out their taxes. If you provide better customer service, people feel more committed to the whole process, and there's less tax evasion. I think it's almost I don't want to say unpatriotic, but it can't be right to think that over a decade we can't meaningfully improve tax compliance coming off a decimated agency.
Let me close today by asking you, that's a new idea of yours, actually. Outrage of the week. What outraged you this week, Larry Summers?
David, Bloomberg reported that we are only raising half as much money from the estate tax as we used to. Even as fortunes at the high end have soared, even as inequality has gone way up, even as more and more children of privilege are being able to live lives where they don't have to work because of what they inherit. I don't understand why progressives feel a need to move to exotic new schemes like wealth taxes when there's a lot of money to be raised and a lot of justice to be served by simply reforming the estate tax to make it work. And that's something where people who believe in incentives should believe in estate tax reform, because I don't think any American should inherit money in a way where they've got no incentive at all to work.
Larry, it's always so great to have you with us. It's a privilege. Thank you so much. That's Larry Summers of Harvard, a very special contributor to Wall Street Week. Coming up, your patriotic duty to get back to work. This is Wall Street Week on Bloomberg. Finally, one more thought. The Chinese import we didn't necessarily expect. 4 months ago, right here on Wall Street Week, we talked about a new Chinese phenomenon called lying flat. At the time, we thought it was something of an oddity. Began 5 years ago by a 25-year-old factory worker named Luo Huazhong, lying flat is spreading through the youth of China. Tired of the long hours, they've decided to take it easy, giving up their jobs, living modest lives off of their savings, and sometimes off of their parents. But now, U.S. workers seem to be taking a chapter out of the lying flat book from China, as U.S. companies just can't get the employees they need to come back to work, as we heard last week on Wall Street Week from Sarah Ketterer of Causeway Capital.
The cry we hear from companies, and we interview hundreds of companies, is that they don't have the labor they need. There seems to be this chronic labor shortage, which is something we haven't seen. Normally we talk about slack, and that doesn't appear to be the case. And it's not like the labor isn't there somewhere. It doesn't seem to want to work in many of these jobs. And that ultimately may lead to a solution in automation or types of labor replacement. But in the interim, that means that the wage has to rise in order to attract the labor that's needed.
People speculate about the reasons. Liz Schuler of the AFL-CIO says the jobs just don't pay enough.
There is a shortage of good, high-paid jobs in this economy, and working people are reevaluating. Coming out of this pandemic, do I want to sacrifice my health for a low-wage, dead-end job?
Jason Furman of the Harvard Kennedy School says that it's a combination of having enough cash they don't need to get back to work and being worried about COVID.
There's a number of factors related to COVID, its psychological fallout, the extra cash that families have, and just some resorting that always happens when people lose jobs and need to gain them back. So I would put most of my money on 90% of these people are going to come back. I think it could take a year or two for them to come back, so a lot of pressures in the meantime, but I wouldn't write people off long term.
And some, like Mark Cohen of Columbia, say it really is just a matter of time before those workers come back on the job.
Wage rates have gone up, benefits have gone up. In some cases, benefits have become unprecedented. Amazon is offering college tuition for folks who join them and who stick around. So we're going to have to wait this out. The one thing we can probably count on is that the labor shortages, the labor disruption will slowly abate because, in fact, most folks have to go back to work.
But whatever the underlying reasons, our leaders around the world are using their bully pulpits to try to get us all to come back to work. Whether it's the Chinese Communist Party talking about lying flat and calling it unjust and shameful, or former U.S. Labor Secretary Elaine Chao saying we owe it to our country and to our economy.
As the economy continues to recover, we're going to need these workers to do their patriotic duty to come back and help the economy to come back.
So maybe we need to take a page or a poster out of U.S. history and make it really simple. This time, Uncle Sam not only wants you, Uncle Sam needs you. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.